In this video, traders, we're going to look at the importance of catalysts when trading stocks. Stay tuned. Hey traders, a very warm welcome to you. So, the importance of catalysts when trading stocks. Catalysts are an event that comes out that significantly revalues that stock, or indeed the market. It could be trading gold, could be trading crude oil, could be trading a currency pair or an index, doesn't matter. The point is something comes out that gives that stock a boost. And let's say, for example, now we're looking at kicks to the upside, right? So we have a stock that's sitting there doing not a lot. It's maybe in a small uptrend, maybe it's in a range bound environment, maybe it's doing something or nothing. It doesn't matter. The point is, why it's so important to have a catalyst is that what it does, it suddenly shifts the supply-demand imbalance in one significant direction. If you can imagine, this is what it was before, and perhaps you've got a little bit more demand coming in supply, and you're causing maybe a little bit of an uptrend, a little bit of trade back and forth, and you see those charts all day long, don't you, flipping up and down, and you kind of look at some chart patterns on them, and them chart patterns might work okay, but when they really work is when you have that external flow of money that comes in only when you get a catalyst. So they have great earnings. What happens is you have this initial scenario, so you get more people who were buying suddenly buying more, you get people who were selling suddenly selling less, and in addition to that, you get other time frame participants getting involved to the upside. So all that creates what we're looking for as traders, which is supply demand imbalance. We want to see a significant shift in supply demand imbalance. That's why it's so important for the catalyst. So what catalyst could we have? We could have earnings. We could have even things, guys, like a short interest. If a stock has got a huge short interest and this thing is still pushing higher and higher, that short interest could be the catalyst for it just ripping into the stratosphere. And there's great examples out there of short squeezes where really the price has just grinded up, but it's got to a point where it's gone so high that it's squeezed those shorts into closing, and that cascade has caused a real kind of exhaustion move to the upside. It could be earnings, it could be some kind of trend shift, but generally it's one trigger. And actually when you start adding these all together, you start to say, okay, well, there's a short interest and we have positive earnings, all of a sudden that's when you get pure fire. That's where you get stuff that really starts to rip, because the supply demand is already in one direction and you've got almost like a big kind of canister of fuel waiting there. So when the catalyst comes in, those shorts are just igniting the whole thing. That's when you get real high probability stuff. And to add one extra thing into that, you can add your technical tools in with the catalyst. So there are two ways of trading it. One, you identify a potential catalyst and you take the risk from the outset. Maybe you do some research and you start to go long before. Now, I'm not advocating going long before earnings based on a hunch. That's gambling, guys. But let's say you have identified something. Let's say you've identified a trend change. You've done some research. You recognize that this relates to that, relates to this, relates to that, and you're positioned for an improved earnings cycle, whatever it may be. Now, again, we're not just doing this on a hunch. We're not just doing this because we use the product. We're doing it based on some research we've done, and we believe that if they miss earnings, the downside is going to be, let's say 3%, but we think that if they hit earnings or beat earnings, the upside is going to be 12%. And so we kind of position ourselves for that catalyst before the catalyst. We understand what the catalyst could be. We don't know what actually the outcome is, but we know where it's coming from potentially, and that is going to be a trigger for our trade. What I prefer to do, and what is a little bit safer, is to wait for the catalyst and then react as quickly as possible before the rest of the crowd jump on the catalyst. So the catalyst could be, like I say, good earnings on stock, on the company earnings, comes up, rallies, kind of pauses very early on. So you get perhaps a strategy or a chart pattern that you like to trade as well. So you add a little bit of technical in there, combined with the catalyst, gives you that extra power. And like I say, you've got the kind of skew of supply demand, you've got the increased money flow from other time frame participants, the pain of the people who were wrong, the more money flow coming in, and if you get it right, you create a perfect storm. That's why catalysts are so important when trading stocks.